Welcome everyone. So what we're going to do today is going to dive deep into macroeconomics from where we stopped. In yesterday's discussion, we spoke about the calculation of GDP, the gross domestic production of an economy based on production or expenditure approach. And today what we're going to do is we're going to talk about how do we calculate GDP based on income approach. Essentially, expenditure approach and the income approach is going to give you the same GDP simply because expenditure of one party in a society becomes the income of another party. So that's what we say when you are calculating your GDP, whether you are calculating based on expenditure approach or whether you are calculating using income approach, it should technically give you the same output. Now, here we are going to talk about your GDP based on income approach. That is, you are going to calculate your GDP based on your national income plus your capital consumption allowance. So what is the meaning of capital consumption allowance is that, every time, companies have to spend money on maintenance capex. Right? So what do you mean by maintenance capex is that you need to spend some amount of money to replace worn out physical capital. That's what you need to add that in your national income. And then, this is very important statistical discrepancy, which means when you are calculating your GDP based on expenditure approach, it might not be equal to your GDP at income approach, and there could be some differences here and there due to the errors incurred in calculating GDP under both approaches. Because calculating GDP is not an easy exercise because there are so many problems like double counting, various issues come up. So because of that, you might have some difference. So that is what we call statistical discrepancy that gets added into your GDP to match both approaches. Right, now moving on to national income, how do you calculate the national income? We are going to look at what are the type of income that goes into your national income. Let's look at it. If you look at employees' wages and benefits, you're going to take about that's the income for the households, basically the salaries, corporate and government profits. So this is the profits of the companies, where the private sector or public sector companies, their profits at pre-tax level. Then the interest income, if you deposit money in banks and receiving interest income, or if you invest in bonds and that give you interest income, that should get added. And then unincorporated business owners income, you know, they are not incorporated businesses, but unincorporated like proprietorship. So those incomes should go in. Rental income, indirect business taxes minus subsidies. So that is also should be taken into account. This is the income for governments, but you're actually talking about indirect business taxes. Indirect taxes are taxes that are charged on the goods and services. The income taxes that are charged on the income is called direct taxes, but this is called indirect taxes, indirect business taxes minus subsidies. So that's going to be the net tax revenue for the government on their indirect taxes. So if you're adding all of them, that becomes a national income. The thing is this, you should understand something very important here. I'm going to ask you something. Now, in this case, why are we not talking about, government revenue in terms of direct taxes? Now, corporates make profits, and on the profits, they pay taxes to the government, and that income should also be part of your national income. So, can you identify? The answer is definitely in here if you carefully pay attention to what are the things that we are looking at. You are precisely right. If you're talking about corporate and government profits pre tax, That pre-tax also includes the taxes that are going to be paid to the government. So that's why we are not separately adding that, because if you add the taxes paid by the corporate entities and public sector entities to the government, then that means you are double counting, because you are taking pre-tax. Pre-tax include those taxes, so you shouldn't be taking taxes separately, because that's why we take indirect business taxes, which is like VAT, for example, value added tax, or goods and services tax in some jurisdictions called GST. Those taxes are indirect taxes, they are not part of elsewhere. So that should be added after deducting subsidies. Subsidies are deducted because they are an expenditure to the government. So you take the net revenue for the government after deducting indirect business taxes. But you should be careful when you are taking pre-tax revenue of corporate profits. You should be taking direct taxes as an income for them. So this is what we are calculating income of an of a country. This should technically be equal to GDP calculated on an expenditure approach, right? So what is expenditure approach? Is basically C plus C plus I plus G plus X minus M. That's what we looked at yesterday, right? So we'll go more detail into something more. You should be able to understand what is the meaning of personal income and disposable income. So personal income is the pre-tax income received by households. This should also include transfer payments. So what are transfer payments? Remember, we always said transfer payments, are they part of your GDP? Yes or no? What do you think about it? Do you include transfer payments in the GDP? Do we include transfer payments in GDP? What is transfer payments? Transfer payments are unemployment benefits and any subsidies paid by the government to unemployed people or aiding families in a particular country. Those things are not included in the GDP. But when you are calculating personal income, this is the total income of an individual. So for that, you also take the pre-tax income of people. Also, you should add transfer payments, because that also gives them the purchasing power. Now, what is disposable income? Disposable income is basically you take your personal income and you are going to deduct the taxes that households needs to pay, the income taxes. So if you deduct the income taxes that you need to pay from your personal income, that becomes your disposable income. What is the significance of this? Disposable income is the income that you can spend. So this is what normally we use to judge purchasing power or wealth in a particular society. Exactly, that's exactly right. This is the money that is available to spend. There is something more which is not in the slide, which is very often used. Some people call, there is something called discretionary income. So, personal income is your income pre-tax. Disposable income is the income after paying taxes, the money that you can spend. There's something called discretionary income. That means you take your disposable income, you also deduct the money that you spend on your essentials, right? Your food, your shelter, things like that. Then when you deduct them, that becomes the amount of money that you have, which you can spend on discretionary items, luxury things, holidays, and things like that. So that is what you call discretionary income. So that's again something important to understand, because discretionary income will reflect how much household have to spend on non-essential goods and services. Right, moving further down, so this is very important. Now we understand there are two approaches to calculate GDP. What are those two approaches? Can you talk about it? What are the two approaches that we use in calculating GDP? What are those two approaches? We say that there are two approaches in calculating GDP. What those two approaches are? income approach, and expenditure approach. In an expenditure approach, what we do, we calculate the value of goods and services using final output, final value of goods and services, or we can add value added in each stage of the production. We already spoke about it. That is your expenditure approach. And in the income approach, we are going to take the national income, add your capital consumption allowance, any discrepancies, statistical discrepancies, you add them. That becomes your GDP in income approach. But technically, you should know both of them should be equal to each other. So now let's understand this formula. GDP equals to C. What is the consumption? This is the amount of money the households spend on your consumables. You spend money on your food, your shelter, whatever you consume. That's your consumption. And then you have your investments. Investments is again spending, but it is not spending on consumables, but they are spending on investments. So these investments can be, maybe you are investing into a real estate property, things like that. So that's investment spending. And then you have government spending. Government can spend on various things. They might spend on their public sector entities to pay salaries. They might even spend on capital spending like infrastructure and things like that. That's your government spending. So G stands for government spending, I stands for investment spending, C stands for consumption spending, and then you have X minus M. X stands for exports, M stands for imports, and that is your net exports. Now you can ask me, some people often ask me, why do you say X minus M is an expenditure, it's an income? You might sometimes, when you sit back and think about it, you might have these confusions. So I thought I should clarify that to you. When you say X minus M, you might think it's an income, but you're thinking from a country's perspective. From a country's perspective, yes, it is an income, because exports is when you export, you get money. When you import from other countries, you pay money. So net exports isn't income for you. But basically, you got to think about it. This is the amount of money that foreigners spend on your goods and services. So from an expenditure approach, if you are estimating GDP, you need to take your net exports. So net exports is exports minus imports, is the net amount of money your foreigners spend on your goods and services. So when you want to calculate GDP in expenditure approach, you need to take X minus M, not M minus X. You've got to be careful there. This is the money that foreigners spend on your goods. But if you take net imports, then it's like not your GDP. That's going to be the money that you spend on other countries' GDP. So it should be always X minus M. You should remember that. Right, so now if imports are higher than exports, and then that gets deducted, because then you're going to have, there's a question here, what if the imports are higher than the exports? So I'm trying to clarify that. So then what happens? Your trade account, we call them as a trade account. We will talk about them in balance of payments in details towards the end of economic study session. But if you have a negative trade account is exports minus imports. If you have a negative figure, meaning your imports are more than the exports, that gets deducted from your GDP. So technically your GDP is going to go down. Why? Because you are spending money on other people's production, isn't it? It's not part of your GDP. Hope you get that logic. Moving down to income approach, consumption. We are putting that common for both, because if you are consuming on one side, that is your expenditure. But from who are you consuming? You're buying it from a shop. So for them, it's an income, isn't it? So that's why we could see both common. And then you have savings. Savings is what you save, and then you invest. You invest the savings, isn't it? What you don't consume is what your savings. What can you do in an income approach? If you have income, you can consume the income. What else can you do? Can you save part of it? And that is the saving. Later you invest, isn't it? So if you have income, you spend, which goes as consumption. Part of the income you save, and part of the income you pay as taxes, isn't it? Part of the income you pay as taxes, and that goes as an income for the government. You think about it, if your overall income, what you do, you spend, you save, you pay taxes, and that is an income for government expenditure for you. But from a government perspective, it is income. So one way to look at it is how to understand this. How do you understand this? Is your income approach C plus S. On your income, you consume, you save, you pay taxes, and then what you do is C plus S plus T, that is your income approach, equals to your expenditure approach, C plus X, I plus G plus X minus M. This is what we call fundamental relationship in economics. So what's going to happen? We are going to now shorten the formula. How do you shorten the formula? We are going to remove C from both sides because it's there in both sides, on the expenditure side as well as on the income side. So we are going to say S plus T equals to I plus G plus X minus M. So you basically, you should be able to be familiar with these formulas easily, and on your own you should be able to say expenditure approach means C plus I plus G plus X minus M. C stands for consumption, I stands for investment, G stands for government spending, X minus M stands for net exports. On the other hand, income approach, consumption plus savings plus taxes. You think about what you do with your income. You either spend or you save or you pay taxes. So that's one on the one side, on the left hand side, and on the right hand side you have your expenditure. C and C goes off, and you have S plus T equals to S I plus D plus X minus M. And then you keep only S, move the T to the other side. So what happens is that you have I plus G minus T, because the T gets, what happens is the T gets added here. So it goes and get deducted from here. So you see what's happening. You have your savings and the equals to. So your savings equals to what you do with your savings. With the savings, you either invest your savings, or you fund government deficit, budget deficit. What is the budget deficit? If you try to think about it, government has got their tax revenue and they got their expenditure. When do you consider you have a deficit in your budget? Sometimes you call it fiscal deficit, sometimes you call it budgetary deficit. We will talk about that in the monetary policy and fiscal policy tomorrow, but for the moment, you should remember that a fiscal policy or a fiscal balance is the government's revenue minus your revenue is the taxes minus your expenditure is your fiscal revenue. And if you have G minus T, and if your spending is more than your taxes, do you have a deficit or do you have a surplus? Can you think about it? Can you tell me this? If a government is spending more money than the income that they receive, G is more, think about it, when G is more and government spending is more and T is less, so your tax revenue is less than the spending, so that is going to be a deficit. Is that right? You're going to have a deficit. So if you have savings in an economy, the household has savings, they can invest the savings part of it. The part of it will be lent to the government. You can finance the government, and the balance can be invested onto your net exports. So that is how you understand this relationship, and I'm going to explain that more in the next slide. This is what we arrived at. S equals to I plus G minus T plus x minus m. So you need to understand this a little bit more now. This is what is S is savings. What can you do with your savings? You can invest your savings, and then G minus T, what is this? This is if your government spending is more, then if the government spending is more than the taxes, then you have a deficit. That's exactly right. So you have your savings. You either spend on investment spending, not your consumption, because if you spend on your consumption, you don't even have savings. So you have savings means you compromise on your current consumption. What is savings? Savings is you compromise on your consumption. What is the opportunity cost of savings? Can you think about it? What is the opportunity cost of savings? Opportunity cost is what you forego. The opportunity cost of savings is the current consumption. Is that right? Because you let go consumption, you save money because you think, okay, I don't want to do this because I don't want to spend all of my money. I want to save that. So that's your savings. So what can you do with that? You could invest if you want to, or you could lend, give a helping hand to the government. Government is issuing, I mean, they want to borrow money, the households can lend to the government, so that's G minus T, where the government spending is more than the taxes, they end up with a deficit and you fund that. This is what fiscal balance, budgetary balance, the government's budgetary balance, so you can call it fiscal balance, is the same thing. So you have fiscal balance, X minus M. This is your trade account. Trade account is the difference between exports and imports. This is, we're all talking about at country level. At country level, your fiscal balance is your your tax revenue minus your government expenditure will give you whether you have a fiscal deficit or surplus. But here we are, deducting G minus T because we want to get your deficit as a positive number. Sometimes this causes a confusion initially when I was studying this relationship. The thing that confused me was that, I'm telling you because you might probably get confused. So that's kind of a solution for you. Now, G minus T, you might start to wonder why we call this as a fiscal balance, because fiscal balance is your income minus expenses, not expenses minus income. We don't do it this way, isn't it? We just do income minus expenses, so that becomes a negative balance. So this formula doesn't work. For this formula to work, we want to understand where your saving is invested on. It is invested on your investments, or it is invested on your government deficit. So you want to get this as a positive number. If you get a negative number, that gets deducted. So you don't want that to happen. And that's why you do G minus T. You are funding the government deficit. For example, let's say you have a S of $10. What you do with that? You're spending, ignore X minus M, as if you are a closed economy, you do not have imports or exports. Then what happens if you have a savings of $10 and let's say your investment is 6, and what do you do with the balance 4? You are funding the fiscal balance. You're funding the fiscal deficit of the government. And then you have X minus M coming into the equation. If you free up the economy for international trade, you have X minus M. So fundamentally, what happens if you see here, savings are either invested or used to finance government deficit, or used to fund the trade account balance when both exist. So that's what you need to understand. So S equals to I plus G minus T plus X minus M. Right, so there's a question here. What if it becomes G minus T becomes negative? That means that government is lending money to households. That's what it means. If your households have shortages, that becomes the government's lending money. household. So that's what it means. Normally, here what we are trying to explain is that how your savings are deployed. Your savings are deployed into net exports, investment spending, or fund a budget deficit. But if your tax revenue is more than the government spending, and most governments have deficit budgets, and that is why we use this as a theory. So you don't necessarily have to worry about the question that you're asking, but if you have a budget surplus, right? A budget surplus, if you have, then your that becomes negative. So technically, which means that not savings are funding government deficits. It is the government surpluses are funding your savings. It works on the other side. I hope you understand. So moving further down, we are looking at the same formula. Now you need to understand this is a fundamental relationship, and how did we come up with this? We all came up with this. So I mean, basically, you need to know the formula for expenditure approach, income approach, and then you need to know how we derive this. S equals to I plus G minus T plus X minus M. You need to take a blank sheet once the class is over. Try to draw these relationships on your own. See and see if it makes sense to you. It's not rocket science. It's very basic mathematics and some logical understanding of what's going on, isn't it? All right, so let's go further down. So you've got deriving the fundamental equation. So we see what's happening to your savings. And then we are now going to talk about two things. First, I'm going to talk about something called IS curve, income savings curve. And then I'm going to talk about something called liquidity money curve. Here we are going to talk about liquidity money curve. The reason why we are talking about these two is because we are leading towards one of the most important topics today is aggregate demand. We are going to talk about today aggregate demand and aggregate supply. And that's the most important topic for us to discuss. So today's class is going to be very important, starting from slide 82. So all what we're going to do now over the next 5 minutes or so is talking about two curves. One is IS curve, which is income savings curve, and then we are going to talk about LM curve, liquidity money curve, and then we are going to understand how LM curve and IS curve is going to be used to understand how your aggregate demand curve looks like. And from that onwards, we're going to talk about aggregate demand and aggregate supply. That's going to be very interesting stuff. Now, let's get going. Now, this is what your IS curve looks like. So I'm going to now, how this formula works is S minus I. Again, I'm bringing I back onto the income side. So you have your S minus I. When do you think you have a surplus on S minus I? When do you think you have a surplus in S minus I? When your I is more or when your S is more? Exactly, you are exactly right. When your S is more than I, meaning that you are not spending your entire savings. Is that right? You are not spending your entire savings. You are part of the savings you are spending on investments, and part of the saving you are not spending. So your S minus I is a positive number. And what are you doing? You are having your savings, you are first investing the savings, and the excess savings that you have, what do you do with that? What are the two things you would do with that, guys? Can you think about it? You fund the government. When the government doesn't have enough money, they are short of money. Why? Because their tax revenue is less than the money that they need to spend on infrastructure and other form of current spending of the government. If that is not enough, you are funding that, and then you are funding the net exports. That is exactly what you're doing, and this is the same thing. So I'm straight away going into the graph, so it's easy for you to understand. So what IS curve tells you is that it is showing you the relationship between the real interest rates and real aggregate income. Real aggregate income is nothing but your economic output. And economic output is nothing but your GDP. So we are actually talking about the relationship between real interest rate and real aggregate demand, which is your GDP. And remember, IS curve focuses on goods and services market, and your LM curve focuses on money markets. This curve focuses on goods and services markets. So now I'm going to ask you questions. Now, if the interest rates go down, what do? If the interest rates go down, would you keep more money in the bank account or would you spend more money? What are you going to do? It's a very logical question. If the interest rates go down, would you spend more money or would you spend more money or you are going to save more money? Logical question. Assume you don't have any other options to invest anywhere. So when the interest rates go down, you invest your money. When the interest rates go down, you save. You don't save your money. Sorry, you don't save your money. You spend. You're exactly right. But when the interest rates go up, the banks are giving you more interest income for interest rates on your deposits. Then what do? You save. Okay. Now, what happens is that when interest rates go down, what happens is that people spend more money. When people spend more money, your GDP increases. You can also think in a different manner. When the interest rates go down, what will happen to investments? Can you think about that? That is one way to look at spending, and also think about investment spending. What do you think people would do when the interest rates go down? They will not save, but they will take the money and invest because you want to get more returns and you don't just want to keep it in your savings account. So you invest. So when you invest somewhere, what happens? Your GDP goes up. But what happens when the interest rates goes up? If the interest rates go up, you save. Will you invest more? If the interest rates go up, will you invest more or you invest less? Can you think about it? Interest rates going up, you invest less. Why? What would you do? If the interest rates go up, what will you do? You save. If you save, you don't spend, you don't invest. On the other hand, when the interest rates go down, what do? When the interest rates go down, would you save? Would you save or spend? No, you spend, isn't it? You spend. When the interest rates go down, also you invest. Spend on investment. So when you do that, what's going to happen? Your GDP is going to grow, and that's what we say. When your interest rates go down, GDP will increase because the investments will go up. Investment goes up, economic output will go up. But when the interest rates go up, what happens? You'll see the real aggregate income. That is what your GDP. At lower interest rates, your GDP is more. At 4% interest rates, your GDP is more, but at 6% interest rates, your GDP is high. Yeah, that's exactly right. There's a question here that means government can reduce the rate to boost the GDP. And if you see, this is not done by the government, but it's done by the central banks. They manage the interest rates. And this is what done globally, right? When there is recession, central banks, what they do, they reduce the interest rates. When they reduce the interest rates, what people do is people, spend money, invest money, Businesses borrow money and invest because it's cheap for them to borrow money and invest. So that increases employment opportunities, that increases GDP, that's good for the economy. So that's what IS curve talks about. The IS curve is downward sloping. It's talking about real interest rate and real aggregate demand. So that's what IS curve is all about. Now I'm moving on to liquidity money curve. So what is liquidity money curve talks about? You need to understand. Liquidity money curve talks about the relationship between money supply and money demand. You need to first understand what is money supply is the amount of money available in the public, amount of money available in a particular country is called money supply. Money demand is the amount of money people want to keep in their hands. That is what your money demand is. The demand for money is what the amount of money that you want to have in your hands. So that's your liquidity money. So you should understand what is your money supply and what is your demand for money. We'll talk about demand for money later in macroeconomics. But for the moment, you remember what demand for money is the money that you want to keep in your hands to spend in the future, or supply of the money is the amount of money available. So now what happens is that if the interest rates go up, okay, now what will happen for demand for money? Think about that. What would happen when the interest rates go up? Will you keep more money in your hands? If the interest rates go up, will you keep more money in your hand? Yes or no? No. You don't keep more money in your hand. So what's going to happen is that real rates going up means, real interest rates going up means your quantity demanded for money decreases. And when your income is going up, your quantity demanded would increase. So basically, we need to say, end of the day, if your real interest rate is more, you are going to have higher income. So now, this is going to be conflicting. You see what I mean? The reason why we are talking about your LM curve and your IS curve, because IS curve focusing on goods and services market and LM curve focusing on money markets. The relationship between interest rates and GDP in IS curve and in LM curve is explained in opposite directions. If you talk about in IS curve, is your curve downward sloping or upward sloping? What do you think about it? It is downward sloping. So what does that mean? Lower the interest rates, higher the GDP. Higher the interest rates, lower the GDP. That's what we said. But in LM curve, what we say, look at what's happening here. When the interest rates are more, your aggregate income is more. And when the interest rates are lower, your aggregate income is less. What does that mean? It is upward sloping LM curve. So you have a downward sloping goods and services market curve, which is what we call it as IS curve. And you have an upward sloping LM curve. So they work in the opposite direction. Here, what we say is that higher interest rates would mean higher GDP. Why? Because if your interest rate is more, if the interest rate is going to go up, what's going to happen? People are going to get more income. Why? In the money market, you invest more money. If you save more money, you're going to get more interest income, isn't it? Think that way. If that makes your life easy, why the curve looks like this? If the interest rates go up, what do? You save more money. If you save more money, what happens? If you save more money, will you get more interest income here? So that will boost your aggregate income because your interest income is going to go up. So now we spoke about LM curve, we spoke about, what is the other one we spoke about? LM curve, and we also spoke about IS curve. And they basically work in the opposite direction. And if you plot LM curve and IS curve, will you find the equilibrium? Yes or no? Can you tell me? Think about demand curve and supply curve. This is what I always tell people. Don't really take this material a bit light if you find it hard to understand LM curve and IS curve. But think about your IS curve as your demand curve and LM curve as your supply curve. And which is the point they meet together? How do we call them? How do we call them? We call them equilibrium, isn't it? From that equilibrium, you create aggregate demand curve. So what we need to understand now, your aggregate demand curve is produced from the equilibrium where your LM curve, which is upward sloping, and your IS curve, which is downward sloping, they are meeting together. The intersection is what we call equilibrium. And then you create an aggregate demand curve, and from now it's going to be more exciting. It's going to be more exciting and more important from now on. So you've got to pay attention now. Look at this. This is self-explanatory. Your demand, aggregate demand. Think about your prices. Think about your GDP. When the prices go up, what will happen to the demand? What happens to the demand when the prices go up, guys? What happens to the demand decrease? When the prices decrease, what happens to the demand? Increase. So this is why we say there is an inverse relationship between price and demand. We spoke about them in microeconomics on price-demand relationship. Even on a macro level, what is macro? Macro is basically you add all the micro variables together, that becomes like a macro thing, isn't it? Macro doesn't come like a big bang. It's not a big bang. It doesn't just come overnight. Macro is nothing but you are consolidating all your micro variables, and that becomes your macro, isn't it? So you have your aggregate demand curve, which is downward sloping, which means when the prices go down, you have more demand. When the prices go up, you have less demand. So we spoke about now aggregate demand curve. You understand how that works. Now aggregate supply. This is going to be interesting. Aggregate supply in the very short run, aggregate supply is elastic. You can adjust your supply the way you want. I'm going to explain that using the curve. In the short run, input prices are fixed, so businesses can expand real output, prices increase. In the long run, aggregate supply is fixed at full employment of potential real GDP. And this is what I'm going to explain you now in detail. I'm going to explain slide 83 now. We are talking about aggregate supply. First of all, tell me something. Aggregate demand curve is downward sloping, and aggregate supply curve is upward sloping, which is in line with what we studied in microeconomics. When the price levels go up, what happens to your supply? Can you think about it? What happens to your supply when the prices go up? What happens to the supply? What do suppliers do when the price levels increase? Do they supply more or do they supply less? What do they do? What do they do when the prices go up? The demand drops, but what happens to the supply? When you think about it, when the prices increase, the demand drops, but what happens to the supply? Supply curve, is it upward sloping or downward sloping? What happens to your supply curve? Is it upward sloping, isn't it? Why? Because suppliers, they get motivated to supply more when the prices are more. What is their objective? Their objective is making more money. more and more money. So when do you sell more units? When the prices increase or when the prices decrease? Can you think about it? When do you sell more? When the prices increase, you sell more. When the prices decrease, you sell less. So that's why your supply curve is upward sloping, and that's how you create an equilibrium. Remember, what is an equilibrium? You have your demand curve, which is downward sloping. You have supply curve, which is upward sloping. When they both intersect, that is where the equilibrium. Equilibrium is in practice. I'm a buyer and you're a seller, and I come to your shop and I ask, okay, I want to buy this, and you say, okay, this is $10. I'm going to tell you, I want it for $6. And say if you give me at $6, I'm going to buy 1,000 units. You're going to say no, and then we finally agree on a price and a quantities, and that's what equilibrium is in practice, where buyers and sellers, their understanding is reconciled at one point. That's what equilibrium is. And that's how we created aggregate demand curve, and we are talking about aggregate supply. Aggregate supply curve usually is upward sloping. So this is the beauty here. You should understand. In the short run, your aggregate supply curve, aggregate supply, short run aggregate supply. That is the meaning of SRAS. That is going to be upward sloping. Why? When the prices go up, you are motivated to sell more and you are increasing your output. Okay, how are you able to do that? Because you maybe in the short run, the economy is not at full employment. What is the meaning of full employment is that all the resources are fully utilized. You do not have any workers who could do the work for you. So in the short run, the economy is not at full employment. Economy is not at full employment. So what happens to your supply curve? The supply curve goes up as prices go up, you increase supply. Also, the one more thing is that in the short run, the economy can also work above full employment because people can do overtime. But that's not something that's feasible in the long run. So in the short run, people can do overtime. So what happens is when the prices go up, you increase the supply. But in the long run, think about it. If your economy is at full employment, what do I mean by that? You have used all the available resources. Can you increase your GDP when the prices go up? Yes or no? Can you think about it? Logically, can you increase your supply? You are a supplier, you are a seller selling products to the market. The economy at full employment. You have used all your resources that you have. You have no more resources to use. Can you increase your aggregate supply? You can't. And look at this. This is the best thing for you to learn here. This is your long run aggregate supply, which looks like perfectly inelastic. Why? When the price is going up, but the supply is not going up. Why are you not able to increase the supply? Why are you not able to increase the supply? Any reasons for that? Any reasons why you are not able to increase the supply here? Because you are at full employment. Understand that word. That is very important. You are at full employment, meaning you are utilizing all the resources that you have. Even if the prices go up, you cannot increase your production because you're exhausted. In the short run, if you are not at full employment, you can first increase, unutilized resources, you can utilize. You can bring more staff, you can use more resources, you can increase your production. In the short run, you could also do overtime. If you do overtime, even if you are at full employment, you see what's happening. This is the funny part. In the short run, your GDP goes above full employment GDP. This is your full employment GDP. It's going above because in the short run, you could do overtime and increase more output, you cannot sustain that in the long run. You get exhausted, you get burst. So what happens is that in the long run, your long run aggregate supply curve is stagnant. It's perfectly inelastic. Interesting. Now we are creating aggregate demand curve. Now you're going to see, okay, this is something familiar, isn't it? How do you create aggregate demand curve? Aggregate demand curve is going to show what? It's going to show you prices on one axis, demand, aggregate demand on the other axis. So what do you think your aggregate demand curve is going to look like? Okay, this is question time. You need to answer. How do you think your aggregate demand curve is going to look like? Price on one axis, demand on the other axis. Anyone else wants to answer? What do you think about it? When the prices go up and demand comes down, and the prices come down, demand goes up. So there's a negative relationship. So downward sloping aggregate demand curve. Now, my next question is, how do you think your aggregate supply curve is going to look like? Short-run aggregate supply curve, how would that look like? Short-run aggregate supply curve, that's going to be upward sloping. But the next question for you, how do you think your long-run supply curve is going to look like? That's going to be perfectly inelastic. Can you change the output in the long run when the prices increase? Is it because you don't want to do it, or is it because you can't do it? What do you think is the reason? You can't do it. Why? Why can't you do it? Because you are at full capacity. You are exactly right. Everybody is employed. You cannot get people work overtime in the long run. That will reduce their productivity. So in the long run, you can't do that. That's where the short run supply curve is upward sloping and the long run supply curve is stagnant, perfectly inelastic. You're right. And then the aggregate demand curve, guys, I'm sure you recall what we studied. This is your expenditure function, isn't it? The GDP, calculating GDP on an expenditure approach is the same thing. Aggregate demand is the same. People can create demand for their consumption. They can create demand for investment. Government can create demand for government spending, and then net exports. This is the demand created for our products by the foreign countries. You should understand this carefully. This is the demand created by households. This is the demand created by investments of, you can think about companies, investments created by investments. This is the demand created by the government spending. And this is the demand for your products created by the foreigners, net exports. How do you calculate net exports? X minus M. So don't forget this. Aggregate demand curve, C plus I plus G plus X minus M. Okay, now this is a very important slide. From an exam perspective, I think these couple of slides are going to be extremely important. So now we are going to understand what factors can increase aggregate demand and what factors can decrease aggregate demand. When the aggregate demand increases, that will potentially support an increase in GDP, and that is why countries want to increase their aggregate demand. Now, first of all, increase in wealth. If your wealth is increasing, you are becoming rich and richer. What do you think is going to happen if you are becoming richer and richer? What's going to happen to your C? Your consumption is more. What would happen to aggregate demand? What would happen to your aggregate demand? Your aggregate demand should increase. That's exactly right. C will increase. Think always about the formula. How does aggregate demand function work? C plus I plus G plus X minus M. You should increase consumption. You should increase investment. You should increase government spending. You should increase exports. You should decrease imports. All these factors would boost aggregate demand. Number one, if you expect your economy is going to blossom, your economy is going to go up, economy is going to prosper, what do you think is going to happen? What do you think is going to happen to your consumption? People will spend more or will spend less? People are going to spend more and people are going to invest more because there is optimism everywhere. Think about people thinking about 2021 as a year of vaccination, hope, and recovery. At least now we see more cases coming up everywhere with mutations and variants. But if you think about a couple of months back, people actually thought about 2021 as a year of hope and recovery. Still, it would be, that's the hope at least. Now, so basically, if there is a hope, people tend to spend more. And if there is no hope and there's no, you think everything about pessimistic, you don't want to spend money because you're not sure about future. You want to save, you don't want to spend money. See, if you want to invest more, if you want to consume more, you need to have positive expectations. So if positive expectations about the future will increase consumption, will increase investment, that's going to increase your aggregate demand. Okay, now the next point is a great point. If your capacity utilization is more than 85, you are nearing full capacity. What do you think now the firms will do? What do you think the firms will do if you are becoming your capacity utilization in companies? If your production factory has a capacity of 1 million, but you already reached about 900,000, you only have a spare capacity of 100,000, what will you do? If you are a wise businessman and if you think your company is going to continue to grow and there's going to be continued demand, what will you do now? Logically, what will you do if your capacity utilization is going to 90, 95? What does that mean? You are already utilizing 95% of your production capacity in your factory. What do you think firms will do at a very high capacity utilization? Would you invest on capex? Yes or no? Think about it. What do you think about capex? You expand, you invest in capex because you are already at full capacity. You want to now expand your capacity. So if your capacity utilization is about 85%, companies want to spend more on investments to expanding their capacity. And that is why we say if your capacity utilization is more than 85%, it would increase investments. Okay, increase in the taxes. What would happen? Can you think about it? Don't read into it. Think on your own. If the government is increasing taxes, what do you think is going to happen to your disposable income? Disposable income is going to be lower. What is disposable income? Personal income minus taxes. So what do you think? You're going to spend less. Your spending will go down, aggregate demand will go down. I cannot even explain you differently. If the tax rates are increased for businesses, now businesses will decrease investments. That also will decrease aggregate demand. Would you agree with me on a different statement? If the government is increasing taxes on businesses, then the businesses will reduce investments. If the businesses reduce investments, then your aggregate demand is again going to go down. Yes or no? Is that right? Okay, fantastic. That's good. So moving further down, increase in the government spending. If the government is spending more on infrastructure, the government is increasing salaries for their state sector workers, that would increase aggregate demand because G is part of aggregate demand. Increase in the money supply, reduce real rates, and increase I and C. So this is again interesting. What's going to happen? If the money supply increase, means there is money flooded everywhere. Everywhere there is money, then that will reduce interest rates because banks have enough money to lend, so they will reduce interest rates. Companies will borrow and invest. And people don't want to save, but they spend. If the interest rates are lower, I would increase, C would increase, aggregate demand would also increase. Okay, the next one I'm going to spend some time on that. That's a very important point. I will touch base on that even at the last study session on economics. Depreciation of your own currency. If your own currency is depreciating, let's say you are in the United States and you are selling your goods to Euro. Okay, dollar is depreciating against euro. Now, your products which is quoted in dollars in the euro, is that going to become expensive or is that going to become cheaper? Can you think about it? If dollar value is depreciating, dollar is going down. Dollar is going down and you are selling products in dollars to euro, you're exporting. Dollar is going down, euro is going up. Okay, let me give you an example. Right now, let's say 1 euro is equal to, let's say 1.2 USD. Okay, what's happening? Why did I say which currency is depreciating? So let me use the whiteboard, easy to understand. So what happens is that you see current exchange rate is 1 euro equals to 1.2 USD. So this is how it looks like. Now, after the depreciation, which currency is depreciating? Dollar. So it becomes 1 euro equals to 1.25 USD. Let's say 1.3. What is happening to dollar? Is the dollar appreciating or depreciating? To buy 1 euro, you are paying $1.2, and now you are paying $1.3, so your dollar is depreciating. Now, earlier you sold a product, US exported to Europe, a product which costed 100 USD. Okay. Now, in order to export this 100 USD, how much do you think euro that Europeans needs to pay to buy this 100 USD? How much are they going to pay? They are going to pay 100 basically divided by 1.2. That's exactly right. They should be paying 80. They were paying previously, how much were they paying? They were paying 83.33. Is that right? 100 divided by 1.2 is 83.33. Yeah. And now, after the depreciation, did the United States change the price? No, they are still selling the product at $100. They did not change their price, but the exchange rate changed to 1.3. So how much do you think the Europeans need to pay now? They need to pay 76.93. Is that right? 76.93. So now you need to think about it. If dollar depreciated and euro appreciated, what happens to export prices in Europe? If US is exporting to Europe, what will happen to the export prices measured in terms of euro? Is it going to go down or is it going to go up? Can you think about it? Can you answer this question? The prices in euro terms, is it going to go down or go up? We are talking about American goods exported to Europe, priced in dollars. Now, when the Europeans, they pay for it, previously they paid 83.33, now they have to pay 76.93. It reduces. So when the prices reduces, what will happen? The Europeans will buy more products from America or less products from America now. What do you think about it? They will buy more products from America. And this is why we say exporters are always happy about when their exchange rates depreciate. Do you agree? When your exchange rate depreciates, the exporters are happy about it. Why? Because your exports will become cheaper in the international markets. This is what everybody does, isn't it? When euro is depreciating against all other currencies, everybody wants to go to Europe. Think about yourself, right? Now, wherever you are, if you want to do a holidays in euro, but forget about now when your holidays are doomed. But in a normal scenario, if euro is depreciating against your currency, you're going to spend euros in Europe when you do holidays. So when that depreciates, you think the European holidays becoming more attractive, or it's becoming more unattractive? What do you think about it? What do you think the European holidays is going to become? They are going to become more attractive, or they are going to become more unattractive? They are going to become more attractive. So currency depreciation helps from an export perspective. Now let's look at what's going to happen to imports. Now we are going to talk about, okay, US is importing from Europe. Okay, they were importing something which costed 100 euros. Okay, so now how much did America pay before the currency depreciation? How many USDs they used to pay for 100 euros? Can you guys tell me? Now I'm changing the example. US is importing from Europe worth of goods 100 euros. How much do you have to pay? How much did you have to pay before the currency depreciation? 120. There you go. How did you calculate? 100 euro times 1.2 gives you 120 euros USD. Now, after the depreciation, what's going to happen to your euro price? In euro, the price is still the same. So 100 euros times 1.3, it's going to become 130 USD. So what's going to become? What's going to happen to the imported goods and services? What's going to happen to the imported goods and services? Are they going to be cheaper, or are they going to be expensive? They are going to be expensive. So if the imports prices go up, what will you do to your imports? Will you reduce imports, or will you increase imports? Reduce imports. So now think logically, your currency is depreciating. Is it good for exports? Is it good for exports? Yes or no? Is it bad for imports? Is it bad for import? Yes. So a currency depreciation, will that increase your net exports? Yes or no? A currency depreciation will increase your net exports. So what would happen to your aggregate demand when your currency depreciated? What would happen to your aggregate demand when your currency depreciated? It will increase. What will happen to your aggregate demand when your currency appreciates? When your currency appreciates, your aggregate demand will decrease. Why? Because your exports are going to become expensive. Demand for exports will come down. Your imports are going to become cheaper. Imports are going to go up. Your trade balance is going to become negative. That would mean your aggregate demand is going to go down. So I'm going to go back now. This will make more sense to you now. Depreciation of currency increases net exports. Import prices up, export prices down. So when the export price is down, exports go up, import prices up, imports come down. That will increase your aggregate demand. Okay, growth of foreign GDP in foreign countries are becoming more richer. That's going to increase your net exports. Why? Whatever you export is what their imports is. They're importing because they are becoming more wealthier. So which means if foreigners become more, richer, they're going to buy more, they're going to import more, which means your aggregate demand is going to go up. So one important thing that can get tested in the exams is questions can ask you what would be the impact on aggregate demand when one of these factors change. Right now we are moving towards aggregate supply. We're going to talk about, so far we spoke about aggregate demand, which is C plus I plus G plus X minus M. So always when there is a question on aggregate demand, think about the equation and think about this particular factor which is in question, how that's going to affect your equation. Easy way to understand solve any question on aggregate demand. Now let's focus on aggregate supply. We have aggregate supply, we divide them into two, but in aggregate demand we don't. In aggregate supply we divide them into two. What are those? We're going to divide them into short-run aggregate supply and long-run aggregate supply. In the short run, what can increase short-run aggregate supply? Decrease in the input prices, cost of production is lower. Will you produce more or produce less? Will you produce more or produce less? If your cost of production is lower, it's going to become more profitable. Then what are you going to do? You are motivated to sell more. You will increase your aggregate supply. Improved expectation about future. You produce more. Decrease in taxes. You do more business. Increase in subsidies. You do produce more. Currency appreciation, that reduces the cost of imported input. That's a great point. If you are relying on raw materials from overseas, if your currency is appreciating, your imports becoming cheaper, but your raw materials becoming cheaper, means you produce more now. You could think about, if you are a supplier, your objective is making money. So if input prices are decreasing, improved expectations about future, taxes are falling, subsidies are rising, currency is appreciating, and you are importing raw materials from other countries, it's cheaper for you to import them now. So all of this would mean what would happen to your short-run aggregate supply curve? That is going to shift to the right. In the short run, you can do this, because in the short run, maybe you are at underemployment. You are not at full employment. You are below the full employment. Then you have a headroom to increase the supply and increase it. Or even if you are at full employment, can you temporarily stretch yourself and increase the supply? Yes or no? Can you do that? In the short run, can you increase your supply and stretch yourself a bit more because the things are looking positive to you? You could do that. You could do over time. You can do that. The supply curve can go up. But in the long run, all these factors, do you think they will increase your long run aggregate supply? Do you think all these factors will increase your long run aggregate supply? Why is no? Why is no? We already discussed about that. Why do you think it is no? You can't increase your aggregate supply in the long run. What is the reason for that? Why? No more capacity available. You are at full capacity. You are at full employment. You have no workers to do the work for you, even if you want to really increase your production. Now, the next great question you need to answer is, how can you increase your long run aggregate supply? That's what we are going to discuss. Think about this. This is interesting. You need to increase labor supply. How can you increase labor supply? Can you think about it? How can you increase labor supply in a country? How can you increase labor supply in a country? Countries like Canada, countries like Australia, what are they doing? How are they increasing their labor resources? Because they feel that they are at full employment. That's exactly right. Migration, immigration. That will help them to bring in more people so that you can increase your long run aggregate supply. You can, find out, do a lot of mining and see if you have any oil and gas reserves, or you have some other resources, or you try to discover natural resources. Think about land, labor, capital, entrepreneurship. These are the 4 factors that is going to drive your supply. That's going to drive your production, isn't it? Remember, we spoke about it. Land, labor, capital, entrepreneurship. Land is all the natural factors. So you want to discover new natural resources that can help you increase long-run aggregate supply, because long-run aggregate supply, why do you think it is perfectly inelastic? Because you can't change it. But if you increase the supply, if you increase the natural resources, you increase the physical capital, fixed assets and things like that, that can help you. Okay, look at this. The last 2, I really like it. increase human capital, increase the quality of labor, give them training, give them better education. When you do that, you're increasing the quality of human capital. So the same human capital can produce more now. So that is a productivity improvement. And then you can increase your technology, bring in labor productivity. You can use the same inputs. Your inputs are not increasing. You are at full capacity. I agree you are at full capacity, but can you use the same inputs and now achieve more outputs? How can you do it? How can you do? How can you achieve the same output, more output using the same amount of inputs? What can you do? Can you do it? Can you find out better way of doing things? Move towards more capital intensive technology. When you do that, can you increase your production in the long run, although you are at full employment? So remember, this is a great slide. How can you increase long run aggregate supply? You are already at full employment. But if you bring more people from outside, increase discovery of natural resources, increase physical capital, increase the productivity of technology, can use the same amount of input and produce more output. That can increase long run aggregate supply and increase the GDP in the long run. And this is how countries grow. How do you think countries grow? I mean, you should have asked that question from me. I mean, if you think your long run aggregate supply is stagnant, full employment, how countries are growing? How are they increasing their GDP? They are increasing the GDP because they are increasing the GDP. Why? Because they are able to do that because they're increasing the productivity, or they're doing any of these things to increase the GDP. So these are the sources of economic growth. These are not the sources of economic growth, they are temporary. The sources of economic growth is you should increase your available resources, or what else you need to do? You should be able to answer this question. We are nearing break. I'm going to give break now towards the prayer timing now. So just one question. You can increase your GDP by increasing your available resources. Number one. What is another option for you to increase your GDP without increasing your available resources? You should answer this question. You don't increase your resources. How can you increase GDP? You don't increase investments, you don't increase natural resources, you don't increase labor supply, your resources are flat. How can you increase your GDP? The point is this: if you have 100, it's a very simple question. Improve productivity is the right answer. Basically, this is the thing. What I'm talking about is if you have an input, let's say of 10, if this is 10 is your input, and you are producing 10 output. This is what you're doing now. Okay. If you want to increase the output of 10, which is GDP, you increase your input to 12. How can you increase input? Bring labor supply, increase physical capital, increase natural resources and things like that, discover them. That is one way. But if you don't want to do that, how can you want to keep the inputs at 10? How can you increase your output? You identify technology which can use 10 inputs and produce more than 10 output. That is what productivity improvement, and that is a major source of economic growth in developed countries. You got to understand that. So that's where we are stopping now, and we are actually going for break now, and we are going to be back in 15 minutes. It's 2:55 p.m. local time, and we are going to be back at 3:10 p.m. Thank you. Okay, guys, we are back in action again. So we are going to talk about from slide 90, where we're going to talk about short-run disequilibrium. This equilibrium is where your demand curve, aggregate demand curve, and supply curve will have some mismatch between them, and that's what we mean disequilibrium. And remember, the disequilibrium is just temporary. The economy needs to be soon back to equilibrium. So how that happens is, and again, I'm just reminding you what is equilibrium is where there is demand and supply curve intersects, and that intersection is what we call equilibrium. So now think about what happens in the short run disequilibrium. So look at below full employment and you have above full employment. So this is what we are looking at. So now look at this. Let's take it separately. Let's just focus on this one. Your economy is below full employment. Now, what's going to happen is that this is your aggregate demand curve, downward sloping. When the prices go down, GDP increases, prices go up, GDP decreases because of the effects on aggregate demand. On the other hand, short-term supply curve increases when prices increases. How people are able to do that in the short run? The first question that I want to ask from you, can you think about it? How can you do this? How can you increase your, when the prices go up, how can you increase your short run aggregate supply? Can you guys answer this? This is a very important question. We already discussed about it. How can you increase your short run aggregate supply when the prices go up in the short run? Can you increase the resource utilization? Yes or no? You are not at full employment anyway. So if you are not at full employment, can you increase your output by increasing the resource utilization? You can, and you are even going above your full employment GDP, which is your full employment GDP. This is your full employment GDP. How are you going above your full employment GDP? How is that possible? When the prices go up, you are even going above the full employment GDP. How is that possible? How is that possible? The aggregate supply is increasing because you have underutilized resources. The economy is below full employment. So when the prices increase, you are motivated to produce more so that your short run aggregate supply increases. But it is also increasing above full employment GDP. How is that happening? I mean, we assume there is no new resources identified, no productivity improvement, nothing happening. How are you increasing above short run aggregate supplies, above going above long run full employment GDP? Because you are doing overtime. Doing overtime. If you do overtime work, you're doing, I mean, you need to work 8 hours a day, maybe you do 12 hours a day. So then that way you are increasing the number of available labor hours. If that increases, your GDP will increase in the short run, but that's not something that you can sustain in the long run. So remember, we are talking about short run now. So now when this happens, so what you look at this, now this is where your GDP is. So is the GDP below? Okay, answer these questions. The GDP one. Is your GDP below full employment GDP or what it is? It is below full employment GDP. Are you guys there? Is it full employment GDP or below full employment GDP? What it is? It is below full employment GDP. Now, what happens at this situation? Okay, at this situation, what do you think about demand for labor? When there is, if it is the case, there is more unemployment. That's what it means. There is more supply of labor, but no companies are recruiting it. So what will happen to the salaries now? Can you start to think about it? Wage pressure. What do you think is going to happen to the wage pressure? Wage pressure is going to go down or going to go up? the economy is underemployed, if you are below full employment, what would happen to your wages? Unemployment rate is more or less. Unemployment rate is more because you are below full employment. Your unemployment rate is more. So if the unemployment is more, what are you going to happen to your wages? Your wages are going to reduce. Is that right? The wages are going to reduce. When the wages are going to reduce, the input prices are going down. Now what will suppliers do? Now, what will suppliers do in the short run? If the input prices are falling and the labor is available at a cheap price, they would produce more. And what do you think is going to happen to your aggregate supply? Look at what's happening. Your aggregate supply. So look at what's happened where you are now. And there is downward wage pressure. You are back to full employment again. So that's what's happening. So let me explain one more time. What's happening is you are producing below full employment. So you are producing below full employment GDP. Now I'm going to tell you what happens is that at this point in time, is this equilibrium or disequilibrium? Disequilibrium is where your economy is above full employment GDP or below full employment GDP. That is what disequilibrium in this context. So how will this economy will be brought back to equilibrium? Because at this level of GDP, there is unemployment, there is downward pressure on wages. To take advantage of that, companies will recruit more labor. What would happen to your aggregate supply? What would happen to your short-term aggregate supply? Your short-term aggregate supply will increase or decrease. In this case, here, this is a disequilibrium point. Now, there is a downward wage pressure. So when there is a downward wage pressure, what will happen to your short-run aggregate supply? Is it going to increase? Yes, that's going to increase towards long-run aggregate supply curve and full employment. So your economy is brought back to equilibrium again. See what's happening. Now, we are going to talk about you are above the full employment. Look what's happening here. This is what is your GDP one? Is the GDP one above the full employment GDP or it is below the full employment GDP? Can you look at the second one? Is your GDP is above full employment GDP or is it below full employment GDP? It is above the full employment GDP. Now, what's going to happen? If you're above the full employment GDP, you are in GDP 1. What's going to happen to your wages of staff, wages of employees? You know, here you are overemployed. Your unemployment rate is very less. People are even doing 2 shifts. People are, doing more hours. So what's going to happen to your wages? Upward pressure on wages or downward pressure on wages? What do you think at this point in time? When everybody has got a job and if somebody wants to hire you, they're going to pay you more or they're going to pay you less. They're going to pay you more at that point in time. Then what do you think the suppliers will do as a reaction? What would happen to the suppliers at this point in time? The suppliers now, the input prices are going up. The cost of production is going up. When the cost of production is going up, they produce less. Then what will happen to their short-run aggregate supply? Will shift to the left or will shift to the right? What will happen to short-run aggregate supply curve? It's going to shift to the left. It is going to go back to your long-run aggregate supply. And look at this upward wage pressure. That's going to put your back to full employment. So you understand, can your economy be in this equilibrium in the short run? Yes or no? Can your economy be in this equilibrium in the short run? This equilibrium means you are either below full employment GDP or above the full employment GDP. Is that possible in the short run? Yes or no? Is it possible to be below full employment GDP in the short run? In the short run, yes, it is possible. But is this possible in the long run? Is this possible in the long run? Yes or no? It is not possible in the long run. Why? Because your wages adjust on their own. As a result, your supply curve will be back to full employment GDP. Great slide, you've got to understand. Moving further down, now we are going to look at what happens when aggregate demand increases. Pay attention, guys. Now you know everything. You know everything here. Your aggregate demand curve is decreased, downward sloping because negative relationship between price and demand. And your short-run aggregate supply curve is upward sloping because in the short run you can increase your utilization and you can even do overtime and go above your full employment GDP. But your long run aggregate supply is perfectly inelastic because this is the full employment GDP. Now, if the increase in the aggregate demand, anything is increasing, C plus I plus G plus X minus 1, M, anything is increasing there, it will increase your aggregate demand. So when the aggregate demand increases, what happens to your AD? AD shifts to the right. See what happens? AD shifts to the right. So what happens to the price, guys? Can you think about it? I'm going to go back. This is where your price is now. Your aggregate demand, aggregate short-term aggregate supply. You are here. Are you at full employment? Let's start from the beginning. Are you at full employment now? The beauty of this curve is this: your short-run aggregate supply and long-run aggregate supply are intersecting. So the economy is at full employment. Now what happens here? Your aggregate demand is increasing. See what happens? Your aggregate demand increases. So what happens? Your demand curve shifts to the right. Then what happens? You are above the full employment GDP or below the full employment GDP. What's happening to you? You're above. Can you maintain this, guys? Can you maintain this? It has to settle down. It has to go back because you can do this in the short run by over time. Asking people to work more and more. And then at one point they get exhausted. You go back, isn't it? You reduce your supply because at this point in time, what happens to salaries? What happens to money wages? What happens to wages? You are above full employment GDP. What happens to wages? Wages go up. Then what will you do? What will happen to your supply? What would happen to your supply? Will reduce, will be brought back where? Where do you think you will end up? Where would you end up? You should be able to answer. You would end up at full employment GDP. You are exactly right. So look at that. But you got to remember something. There is something changing. It's not like you're back at status quo. You're back at status quo where you were, but what happened to your prices? What happened to your prices? When the aggregate demand increased, your short-run aggregate supply increased, your prices increased. Then you are back at long-run aggregate supply, but now your prices are significantly more. But you are back at long-run aggregate supply. So aggregate demand increased, could not increase the economic growth or GDP, but it increased the prices. And that you know that if the demand is more, supply is more or limited. What do you think about it in this case? Is the supply more or limited? Limited at full employment. So then what happens to your prices? What happens to prices? If your supply is not increasing, prices, demand increases, prices would increase. That's exactly happening. That's exactly happening. If you want to increase the long run aggregate supply, what you need to know, what you need to do. Okay, that's a different question. We are going to discuss that again. But It's always better to discuss that now, and I'm sure most of you will be able to answer. If you want to really increase long-run aggregate supply and create economic growth, if your aggregate demand is increasing, you need to increase your aggregate supply permanently. You increase productivity. That's a good answer. One thing that you can do. What else can you do to increase long-run aggregate supply? There's so many other things that you could do. You can improve productivity, bring in more labor, improve technology, discover new natural resources and things like that can increase your long-run aggregate supply. Then your aggregate demand increases will also increase your long-run aggregate supply. You should understand that. But here we are assuming that none of them are increasing. That is why we talk about a disequilibrium, and then the disequilibrium is brought back to equilibrium again. Okay, that is super. So now we are going to talk about, you should be able to tell me now, decrease in aggregate demand. What do you think will first happen? I'm going to ask you questions now. If there is an aggregate demand is decreasing, any of the components on C, I, G, net export is going to decrease. That's going to decrease means what's going to happen to the curve? Your AD is going to shift to the right or shift to the left. AD is going to shift to the left. Prices down. Prices down or up. Price reduces. Now, are you below the full employment GDP or are you above the full employment GDP? Where are you? You are below the full employment GDP. Now, the resources, the labor resources, are they cheap or expensive? Are they cheap or expensive? Your labor resources are cheap. Now, what will companies do? What will companies do? Will they hire more or hire less? They bring more, they will bring more, hire more, supply more. You are again back at, where are you back at? Where are you back at again? You are back at LRAS, long run aggregate supplies, full employment GDP, but this time prices have decreased. So see what's happening now. Trend shifted left and then it's gone down, but the prices are lower. Why the prices are lower now? Can you tell me what caused the prices to drop? What caused the prices to drop? Why? Why the prices drop? Well, one very simple answer, just one liner. What dropped the prices here? That's on the heading itself. What happened to your aggregate demand is lower, isn't it? Your aggregate demand is lower. Think logically. If supply is the same, big companies are selling the same amount of output, but people are buying less. What will happen to the prices? What will happen to the prices? Will decrease or increase? Will reduce, and that's what happened. I mean, that's not a rocket science, because you look at here, what happened in increase in aggregate demand. In the long run, your full employment GDP could not change, but your prices increase. Why? Why the prices increase here? Why the prices increase here? No change in the supply in the long run, but demand increase. So increase in demand, supply is not changing, prices will increase. And the same thing here. Decrease in aggregate demand. Nothing happened to the supply. You're keeping the supply as it is. So what happens? The demand decreased, will decrease the supply first, but then supply will increase back again with the lower wages, and that will reduce the price. The reduction in the price is caused by reduction in aggregate supply. Fantastic. We are done with that. We are moving on to a new topic called stagflation. Okay, this is fantastic. This is an important topic to remember and very often tested. Describe or distinguish. The question can be either to describe or distinguish in this particular area. So we're going to talk about stagflation. What is a stagflation? Stagflation means you have two problems to address. If you have one problem, the government can easily fix that. There are two problems here. One problem is shortage of products, supply disruption, a massive supply disruption. This happened during the initial stages of COVID-19 with the supply, with the lockdowns. Every country closed their borders to China. There was a disruption in the supply side. So supply was restricted. So when the supply is restricted, what will happen to the prices? Can you think about it? What will happen to the prices if the supply is restricted? There is a sudden drop in supply. Prices go up because there is something shortage. If there is a shortage of something, immediately the prices shoot up. When the prices shoot up, the problem is inflation. So inflation becomes a problem. Yes or no? Do you have inflation? Do you have inflation now? Because there is a supply shortage. We also call it a supply shock. There is a massive supply shock that increased the prices. There is an inflation. Inflation is a problem. Government needs to control that. On the other hand, you have recession. Why recession? Because supply is restricted. When the supply is restricted, do you produce less or you produce more? What do you do? If the supply is reduced, what do? Do you produce less or more? What happens? If the supply is restricted, will you produce less or more? Very simple question. You produce less. So your GDP falls. If the GDP increases its economic growth, if your GDP falls, how do you call it? If your GDP falls for 3 consecutive quarters, how do you call that? What is that? What is the specific word for that? If the GDP is falling, we call it recession. We got a recession. Your GDP is falling. So you have 2 problems to address at the same time. What are those 2 problems? Can you tell me in stagflation, what are the 2 problems? You've got inflation, you've got recession. You can address one problem, but you can't address both the problems. I tell you how to address one problem. If the government wants, they can increase subsidies. Okay. If they increase subsidies to people spend more money. And so meaning there is more demand for goods and services. What will happen to GDP? Okay, you've got to answer this question, then you will understand better. What will happen to GDP in that case? If the government is increasing subsidies, unemployment benefits and things like that, people get more money. So they spend that money on goods and services. What will happen to your GDP? GDP will go up or GDP will come down? What do you think about it? Government is spending more money. If the government is spending more money, your GDP will go up. In the meantime, the GDP will go up simply because the government is spending more money on transfer payments. You get the money, you go and invest. You go and spend that money on goods and services. So there is demand. So GDP will go up. But what will happen to prices? Think about it. What will happen to prices now? Because there is more demand for goods and services. So what do you think is going to happen to the prices? Are the prices going to go up further or are they going to go down because people are buying more goods and services? What do you think is going to happen to the prices? What do you think is going to happen to the prices when the government put in more money? So inflation is again going up. Can you address both the problem at the same time? Can you address recession and inflation at the same time? You can't. You can fix inflation by stopping transfer payments, stop spending. But economy will go further into a deep recession. But if you want to address recession, you pay more money to people, ask them to go and spend. You fix one problem, your GDP will go up. You will be out of recession, but time to realize you are having extremely high levels of inflation. So this is what happens in a stagflation. Remember, stagflation is caused by a supply shock. Because of the supply shock, there is a massive disruption in the supply side, and that is why your production dropped immediately, prices went up, inflation. GDP dropped, countries went into deep recession. That is what stagflation. See, a supply shock decreases short-run aggregate supply, prices rise to P1, output declines to GDP1. Government can address inflation or recession, but not both. It can take a long time to bring back the economy to equilibrium. Okay, this is a good summary. You guys should be able to answer appropriately. This is a very good summary, very useful for CFA questions. So you should be able to tell me aggregate demand is increasing, aggregate supply is increasing. What will happen to your real GDP? Will the real GDP go up or come down or stay the same? What do you think is going to happen? Your real GDP is going to go up or come down? Both are increasing. Demand is increasing, supply is increasing, GDP go up. But prices may increase or decrease depending on whether your ADC is increasing more or AS is increases more. You cannot really tell. But if you know that AD is increasing more than AS, then what do you think will happen to your prices? If your AD is increasing more than the AS, then what would happen to your prices? Prices are going to go up or come down. Can you answer this? AD is increasing more than the AS. Prices are going to go up. That's exactly right. Prices are going to go increase, but you don't know. So you say prices may increase, may decrease. Look at it. Your aggregate demand is falling, aggregate supply is falling. What will happen to your real GDP? Real GDP will fall, but prices may decrease or may increase. Okay. Your aggregate demand is increasing, aggregate supply is decreasing. What happens to real GDP now? Your aggregate demand is increasing, and supply is decreasing. Real GDP may increase, may decrease, because if you supply is decreasing, demand is increasing, so you cannot determine what will happen to real GDP. But one thing you can tell, what will happen to prices? What will happen to prices? Prices are going to go up or going to go down? Going to go up. Why is that? Why the prices are going to go up? Because of what? Why it is going up? Why do you think the prices are going to go up? Because why? Your AD is demand is increasing. When the demand increases, prices go up, and it's double whammy. Why I call it a double whammy? Because prices AD increases will push prices up, and AS is decreasing, supply decreasing will again push the prices up. Look at this, your AD is decreasing, AS is increasing, your GDP can go up or come down, but your prices will fall. Why the prices are falling here? Why the prices are falling when the aggregate supply is increasing but aggregate demand is decreasing? Because why is it? Because the demand is decreasing, supply is more, downward pressure on the prices, but you don't know what will happen to real GDP. It's a great slide to test your understanding. Going into 95, I'm not going to spend much time on 95. I hope you remember this. You should remember something. Sources of economic growth. What can increase economic growth in a country in the long run? Are these factors. You either increase the available resources by increasing labor supply, by relaxing the immigration rules, increase availability of natural resources like discover mining, things like that, increase physical capital like fixed assets, human capital, improve the quality of workers so they can produce more, improve technology, bring in technological advancements, and improve productivity so people can still use the same factors of production but produce more. These are the same factors we looked at, the factors that would increase long run aggregate supply. Remember, any increases in the short run aggregate supply, will that create economic growth? Yes or no? First question. Any increases in the short run aggregate supply, will that create permanent GDP growth and economic growth? Will that create economic growth? Any short-run aggregate supply increase? If your short-run aggregate supply increases, can that create economic growth? No. Why? Is that permanent or temporary? Is that permanent or temporary? It is temporary. Why? Because soon the supply curve should be brought back to your long run aggregate supply at full GDP. If you want to increase the GDP, you're exactly right. Your economy will be brought back to equilibrium. If you want to increase the GDP, make sure you shift the long run aggregate supply to the right. If you want to do that, bring in new factors of production or increase productivity. These are the two things you can do. It's a great slide again. Okay, now these are different models. We're going to talk about different models, not so difficult ones, very easy to understand. We are trying to calculate sustainable growth rate in a country, potential GDP. So in this model, what they are trying to explain is that your potential GDP is the maximum GDP that you can come up with in an economy. You multiply your labor hours, number of hours people work, and the labor productivity. If you multiply labor productivity by the labor hours, you get the potential GDP. That's what this model says. So this model says your potential GDP is a function of two things. What are those two things? What are those two things? It's already given to you. I'm just asking you the questions just to repeat so that you remember. What are those two things that you need to focus on? You need to, if you want to increase your potential GDP, what you need to do, you need to increase the number of hours you work, aggregate number of hours. So you identify all the people who work in a country, multiply it by the number of hours that they work, add all of them together, that's the aggregate hours work, times the productivity. So these are the two factors that's going to have an impact on your sustainable growth rate. So your growth in potential GDP, you either grow your labor force by relaxing your immigration rules, or you grow labor productivity, provide training, good education, those things can improve productivity. Long run equity returns are dependent on sustainable growth, and this is why equity analysts are more concerned about the economy. Think about, we spoke about in equity, we said in a top-down analysis, you first look at the economy, then you look at the industry, and then you look at the company. And this growth rate at which the country can grow can be used as a terminal growth rate in your DCF or in your dividend discount model, in your equity valuation. Always, if the economy is growing steadily, that is positive on the equity stocks. Okay, now there is another model. We are talking about production function approach. This is sustainable growth. This is production function approach. What we are talking about, y equals to a times function of labor and capital. L stands for labor, K stands for capital. So y is your aggregate economic output, which is GDP. So again, what we are saying is your GDP of a country is a function of productivity, which is A, total factor productivity, which means we are not only talking about labor productivity. The problem with this model is that this model only focuses on labor productivity. Here we are talking about total factor productivity, which is the productivity of capital, productivity of labor, productivity of land, everything together. That's this productivity. And then your labor, the size of labor, size of capital, size of labor, size of capital, and the economic output. How can you grow your GDP? I'm asking you a question. Three things you can do based on this formula. Can you tell me those three things that you can do? Can you do three things to grow your GDP? Can you identify those three things? Very simple questions. What are the three things can you do? Can you guys tell me what those three things that you can increase? Okay, increase labor amount. Okay, increase the labor, the amount of labor. What else can you do? Increase capital. Okay, good. Increase labor, increase capital, improve technology. If you improve technology, what would happen? If you improve technology, which one is going to go up in the formula? Which one is going to go up in your formula? Y equals to A times function of L and K. You are exactly right. Productivity is going to go up. Factor productivity. So this is what it is. I will also suggest you something. Can you make your technology more capital intensive? Meaning you reduce L, increase K. That is one way you can improve A. Would you agree with me? I'm suggesting you something new. You can change the labor capital mix in your production, use more capital, less labor, that would increase your productivity. That can also increase your production. But if you think about advanced countries, advanced economies, they already have high capital intensive businesses, so they cannot change that and increase the GDP. Instead, the only way is they improve the technology, improve productivity, and achieve GDP growth. The total factor productivity, the increase in output, not from increases in labor and capital, closely related to advances in technology. That is how you can improve A, which is the total factor productivity. This is a better model than the previous one because the previous one only focused on labor productivity and labor resources, did not pay attention to capital, but here we are paying attention to capital, production function approach, and we are moving into the more details of production function approach. One measure of economic progress is output per worker. The same model, what we are doing is we are dividing the output by labor resources. So for one labor, how many output that you are producing? Yeah. So because of marginal diminishing returns, marginal diminishing marginal productivity of capital, progress in developed countries relies on technology. So remember, if you keep adding more labor resources or more capital resources, there is always marginal diminishing returns. If you don't understand what is marginal diminishing returns, you need to go back and revise. When you keep increasing your inputs beyond a point, your production starts to drop because your marginal production continues to drop and becomes negative. So that's why the attention is to improve technology and promote GDP growth rather than increasing labor or capital. Okay. Components of GDP growth, easy to understand. How can you grow your GDP based on the model? You can grow the factor productivity. I think you guys answered even before. Grow productivity or grow capital or grow the size of labor. That can increase your GDP. So that's exactly right. So weights are each factor's share of national income. I mean, how much is weight? I mean, weight of capital, weight of labor, which tells you what is your intensity of capital and labor in your production. Are you more capital intensity or intensive, or are you more labor intensive? Maybe you are 60% capital, 40% labor. If you are a developed country, maybe you are more capital and less labor. But if you are a developing country, maybe you have more labor and less capital. Okay, per capita growth. What is per capita? How do you calculate per capita, guys? If I'm giving you GDP, how do you calculate per capita GDP? How do you calculate per capita GDP? Okay, you take the total GDP of the country divided by mid-year population is what's going to give you GDP per capita, right? So that's a GDP per capita. So, okay, who got the highest GDP per capita in the world? Any guesses? Which country got the highest GDP per capita? That's a great one. Yeah, Luxembourg. Luxembourg is the right answer, but the Luxembourg, because of their lower population, and then if you look at again, Qatar is on the top list among GCC countries because of high hydrocarbon production as well as lower population. Right. So again, coming back to that's GDP per capita, total GDP divided by the population. So you have how can you increase your potential GDP? You can grow the technology and you can increase the capital to labor ratio. Why do you think it is? What are you trying to become? Are you trying to become more capital intensive or are you becoming more labor intensive? What are you trying to do? Like becoming capital intensive or labor intensive, when you are increasing the weight of capital, your capital to labor ratio, you are increasing. When you increase that, what do you think will happen to your GDP? Your GDP is going to go up or your GDP is going to go down? What do you think is going to happen to your GDP? Is going to go up. Why? If you are becoming more capital intensive and you become more capital intensive, what happens to your productivity? Your productivity increases, that will increase your GDP. But you got to remember something. In developed countries, your capital to labor ratio is already very high because you automated most of your factory operations and most of the things are automated. So you use less labor and more capital already. So if you want to achieve economic growth in these countries, the only way that they can achieve economic growth is by improving technology, and that can potentially improve productivity and bring GDP. That's the basis of this slide. Okay, now we are end of that GDP and aggregate demand, aggregate supply. A big ticket item is completed. Now I'm moving on to potentially a smaller reading. Understanding of business cycles. We have spoken about trade cycles, business cycles very often. We know an economy can, go up and down. If you have recession, meaning, bad economic period, your unemployment rates are more, GDP falling down, things like that, and then the economy will recover, move towards a higher GDP, lower unemployment, and things like that. So positive economic factors can come in through recovery. There are negative circumstances. So this is what is a cycle. So it's a cycle means you will not have recession forever. You will not have boom forever. Your booms will turn into recession, and recession will turn into boom, and that's what trade cycles are. You understand, this is what business cycles or trade cycles, how an economy move. Look what's happening. You have a clear GDP here, and you've got time on the other axis. So over time, what happens? You will have recession, boom, recession, boom, recession, boom. So that's what a trade cycle is. Whatever goes up should come down. So that's an automatic stabilizer if you want to think about it that way. See what's happening. This is here over time. Your GDP is here. So your GDP is falling. Look at what's happening. It's trough. Trough. So you have trough. It's a very bad economic period. And then what happens? Your economy reaches peak because they recover. When they recover, again, after some time, GDP becomes lower, you enter into a recession. When you enter into recession, what will happen? Whenever you have recession, government intervention coming into play. Government wants to help people to recover. So a lot of stimulus and change in people's behavior will again bring back recovery, expansion. Then after some time, government realizes the economy is very hot. It is very peak. You got to reduce it, cool down a bit. Then you stop subsidies, you stop spending, Then what happens? Your demand drops, you go into a recession again, changes keeps happening. If you plot an average, the average will be like this. Over time, your real GDP tends to go up as you improve your productivity, but within each time period, you'll say, once in every decade, or I mean, sometimes people say economic cycles run into decades. There are different theories talking about the size of economic one cycle, how many years is one cycle, but end of the day, what I want you to understand is that, once an economy goes up, it will come down. When it comes down, it will recover. But how fast that's going to happen? Is it a V-shaped recovery or U-shaped recovery? This is something that you will have to think about it from, if you read a lot of articles that came up on the economic side on COVID-19, people were talking about V-shaped recovery is not possible. We only have a U-shaped recovery. It's like, what is the difference between what is the V-shaped recovery? If I want to write a V, so what is a V? This is okay. This is a V-shaped recovery. So what happened with the COVID-19, with the lockdown? Economy dropped very fast here. And then when this, okay, because people at the beginning told that, the virus is going to go faster. So what's going to happen immediately when the virus is gone? Economy will pick up again. You will go up. This is what a V-shaped recovery. A V-shaped recovery, and then people talk about a U-shaped recovery. So what do you think a U-shaped recovery? Is it going to be a slower one or faster than V-shaped recovery? What do you think about a U-shaped recovery? It is a slower one. Your economy goes down and comes up slowly and then goes up. The U-shaped recovery is a slow one. So it doesn't seem to be, doesn't seem to be a U-shaped, V-shaped recovery. Maybe it may be a W-shaped recovery. What does that mean? Your economy goes down, go up because there is some hope. People invest more money, and suddenly you have new variants coming up. Again, people's sentiment go down. Again, you come down. That's like there's different theories coming up if you want to read about it. So all of them are part of your business cycles, and that's what I want to talk about business cycles with you now. So moving further down, so this is like something interesting for you to know what happens during a recession. Contraction is recession. So what happens is, think about it. You can please ask me if you don't understand anything here. What happens to your inventory sales ratio in a recession? First of all, you need to understand in a contraction, if GDP falling, immediately, what will happen to your sales? The sales will slow down. When the sales slow down unexpectedly, companies will not be able to stop producing immediately. That would mean your inventory will be built up. So your inventory will be high, sales will be lower unexpectedly, your inventory to sales ratio increasing. That will show you that there is an inventory build up above the normal levels. That is a sign of recession. In early expansion, the economy goes into expansion, going to go up. Then what do you think is going to happen? Sales is going to go up, but do you think companies will produce more immediately? No, because they are not prepared for it. So inventories are lower, sales are increasing, there is a shortage of inventory. So what's going to happen? Your inventory to sales ratio decreased to below normal levels. So hope you understand. Please let me know if you don't. This is an important slide. Okay, moving further down. Labor capital utilization. What happens is, in a recession, what do companies do? They lay off people, isn't it? They lay off people in a recession, and in a boom they hire more people. But it cannot happen overnight, isn't it? Because companies will take some time. Even initially when the COVID-19 came in and people thought it was going to be a recession, but companies waited for some time to see maybe it's a temporary slack and things are going to become normal again. That was the initial thoughts a year ago. right? What people thought, okay, it's going to be just a couple of months, things are going to become normal, and we are talking about after a year, things are going, there were some hopes, but again, things are going up, going down again. So basically, what I'm trying to tell you is that immediately people won't respond. So it's going to take some time. So we're actually trying to see what's going to happen to labor and capital utilization in contractions. If you have a contraction, things are going down, sales drop. But will you immediately drop your labor and capital? Will you do that? Will you immediately reduce your amount of capital and labor? No, you can't do that in the short run. So what you will do, you will utilize them less. You will maybe utilize 60% of your labor, but you will be paying 100%. You will still have capital. You cannot adjust them immediately. So that's what you do. But at the beginning of expansion, what happens? Your sales increase, but you can't hire people immediately. You cannot increase your capital immediately either. So what happens at the beginning of an expansion? Your sales increase, your capital and labor are more extensively used. You ask your laborers to work very hard. You work them, ask them to work 24/7 because you know you are not prepared for it. The economy is growing, it's expansion, but you just can't hire people. There isn't any people to hire immediately. There isn't any capital to invest immediately. So that's what happens. Look at it. At the beginning of contraction, sales fall, and both labor and capital are used less intensively. At the beginning of expansion, sales increase, both capital and labor are used more extensively but when this trend persists, you see that there is more expansion, demand continues to go up. Then what do you think these companies will do now? If you think this situation is permanent, expansion is permanent, what will you do as a businessman? If you are an entrepreneur, what will you do? Can you think about it? If you hire more, you're exactly right. Hire more, put in additional capital, you will adjust. But in the short run, only option you can do is you can use your resources extensively, intensively. Right. And what about in a contraction? If you think contraction is permanent, what would you do to your slack capacity now? You will have a slack capacity, you lay off. You are exactly right. That's what you do. More moving down. What will happen to your housing sector? This is always an interesting question to talk about. What happens to your housing sector? Housing is real estate, and remember, real estate is a great example. It is so cyclical. Remember, we always said there are cyclical sectors. What are cyclical sectors? They do well in boom, expansion. They do so badly in a recession. They are cyclical stocks, and there are non-cyclical stocks like groceries, like utilities, like healthcare. They are defensive sectors, but there are cyclical sectors. They do well in recession. Sorry, they do well in expansion. They do badly in recession. Housing sector is very cyclical. So what happens when the interest rates go up? Demand for housing, will it come down or go up? What do you think about it? Think logically. You don't have to say it just because it's written there in the slide. So mortgage rates going up. What happens to housing demand? Will you borrow more money and buy houses now? You don't. Right? You don't. You reduce demand for housing because you buy houses using mortgages. So you reduce demand for housing. Your income is increasing. What are you going to do? Your income is increasing in proportion to your housing cost. What's happening? Your income is going up, your housing demand is going to go up. Then the house prices are going to go up because you're increasing the demand. Speculation. What do you think? Okay, you feel that house prices are going to go up. Everybody, what are they going to do? They are going to borrow money, invest in real estate now, and this is what happened. Prior to 2007-8 financial crisis, there was a housing bubble. What is a housing bubble? People thought, okay, real estate prices are always going to go up and up and up. Everybody, people who had capacity to buy houses, people don't even have capacity to buy houses, ended up buying houses. Then what happened? The house prices skyrocketed at one point that could not be sustained because they are all both under debt. People defaulted, banks forced sold the houses, they liquidated the collaterals, the house prices came down significantly, crashing down the economy. So that's what happened in 2007 and 8. So these expectations and speculations sometimes drive demand up. Demographics, if you have more younger people, household formations is more, you have more, kids coming up, babies coming up, you have more demand for bigger houses and things like that. That could also increase demand for houses. So that's housing sector, how cyclical they are. Now we are talking about external trade, exports and imports. So what's going to happen? So again, we spoke about that before. So you should understand, if you want to import if the imports are going up, that depends on your domestic economy or foreign economy. Can you think logically? Import, who creates demand for imports? Domestic population or overseas populations? Who creates demand for imports? Can you think logically? Who creates? Domestic. You're exactly right. So if your domestic population have better purchasing power, there is better activities locally, your imports go up and your trade account become negative because higher imports. Exports, if exports to go up, you want to sell more to other countries. Who do you want to improve? Who do you want to be wealthy? You or the export, you or the overseas countries? Domestic or international? What do you think? Domestic or foreign? Overseas. Because if you are thinking about them, because if their living standards go up, they buy more from you. So if that happens, your exports go up, your trade surplus will become positive. Also, your exports and imports are influenced by currency exchange rate. Great that we explained this before. I don't have to explain again, so I'm happy. If the domestic currency appreciates, is it good for exporters or bad for exporters? If your domestic currency is appreciating, is it bad for exporters or good for exporters? Your local currency is appreciating. What will happen to exports? It's bad. Exports is going to go down. Why? Because if your currency appreciating, your products are going to become expensive in the global market, demand is going to go down. And imports are going to become cheaper, imports are going to go up. What's going to happen to your trade balance? Exports minus imports. Is that going to improve or is that going to deteriorate? What do you think is going to happen? They're going to go down because it's bad for you. Okay, domestic currency depreciates. Is that good for exports or bad for exports? Domestic currency is depreciating, good. What about imports? Imports are going to become cheaper or expensive with the currency depreciation. Imports are going to become expensive. So if the imports become expensive, what do you think is going to happen to imports? Imports are going to go down, exports are going to go up. That will support your trade balance. A great slide on external trade. Okay, now I'm going to skip 107 and 108 because there's a lot of references to monetary policy and fiscal policy. We're going to discuss that tomorrow and then come back to 106 and 107 and 108. Sorry, 108 and 107 and 108. Getting into more basic stuff, things that doesn't really, cause a lot of strain on your brain after the exhaustive discussion on demand, aggregate demand, aggregate supply, and things like that. This is something easy for you to remember. Get those easy scores in the exam. Okay, look at this. Different types of unemployment. First of all, I want to tell you something. For you to understand unemployment, if you are a guy, a full-time student, you won't be part of unemployment rate. For you to be part of unemployment rate, for you to be called an unemployed person, you should be actively looking for a job but you are not able to find a job, and then you become an unemployed. So when unemployment rates are calculated, this is the logic that they use. So we are going to talk about, we'll come to that. We are going to now talk about different type of unemployments. Frictional unemployment. Frictional unemployment means you are leaving one job because you feel that this is not the job for you. You want to find another one. Or maybe you are laid off, or you are living on your own, whatever the reason. Now, what is your immediate requirement is to find another job. So this is a temporary period between you left your employer and you're going to find a new employer. This period is what you call frictional unemployment. Yeah. Structural unemployment, I think that's very serious. You should understand structural unemployment. Why that happens? That is because, people are not capable of meeting the demand of employers because maybe more digital things are coming up and people are not skilled enough to be, to be able to work in a digitalized world. So if you are not upscaling your skills and capabilities and your literacy on those digital stuff, you will not be able to be employed by those organizations because they don't need your skill set and capabilities, and education is not in demand. This is a very serious situation. Right? So this needs to be addressed immediately because this is a structural decline, means there is a mismatch between the type of labor that you need and the type of labor that you have. That's a structural unemployment. Results from long-term changes in the economy that require workers to gain new skills to fill new jobs. How can you reduce this employment? Can someone suggest something? How can you reduce structural unemployment? How can you reduce structural unemployment? If you understand what I explained to you, what structural unemployment is, you should be able to tell me how can you reduce this structural unemployment. Upgrade skills, there you go. Give them training program, change your education system, maybe. Yeah. That's what you need to do. Cyclical unemployment, when do you think these unemployments come? They come and go. They come during recession and they go up, to near zero levels during expansion. So that's cyclical. It is to do with your GDP. It goes up and down. It works like your business cycles, if you get what I mean. Easy to understand. So now, again, to be counted as unemployed, a person must be available to work and actively looking for work, but not finding. So that's what I said. I told you this before. You should be actively looking for a job, but you are not employed. That's where you're unemployed. So if you are probably, a working partner, sorry, a non-working partner, you're taking care of your kids at home, and then you are not part of unemployed because you are not looking for a job. Labor force consists of those who are employed and those who are unemployed. So this is what labor force is: employed, unemployed. So unemployment rate is number of unemployed divided by labor force. So don't think number of unemployment divided by population. No, you don't look at population. Population includes people who are less than 80, people who are more than 60, 65, so that's not relevant. Some people even think, okay, let's take unemployment rate as number of unemployed divided by working age. Working age when it's 18 to 65 or whatever, that is even not correct, because within that 18 to 65, there will be people who don't want to work for various reasons. Yes, whatever the reason it is, you are not part of it. So labor force, there are two parties part of labor force: the people looking for jobs, people already working. Out of that, what is the percentage of people unemployed? So that is how you calculate unemployment rate. Make sure you know how to calculate them. It can potentially be tested in the exam. So moving down, participation rate, which is, we are going to try to see the size of your labor force, including both employed and unemployed, divided by your working age population, about 16. In some countries, they have an upper ceiling. They say about 16 and below 60 or 65. That's your working age population. So your labor force divided by working age population will give you participation ratio. Do you think this is unemployment rate? Is this unemployment rate, participation ratio? Yes or no? It's logical. No, it is not. It's really not. It tells you, can this tell you how young your population is? How young your population is? No, it cannot tell you that either, because your denominator is 60 to 65 and labor force is XMRs. It tells you how many people are not willing to work within your working age population. Let's say if your participation ratio is 90%, which means out of your age group, 16 to 65 or whatever, 90% people are either working or looking for jobs. Hope you get that point. Either working or unemployed or employed. Okay, that's what participation ratio is. Discouraged workers are those who are available for work but not employed or seeking an employment. Considered not in the labor force and not counted as unemployed. So this is very important for you to understand. Discouraged workers. They are available for work but not employed or seeking employment. Discouraged workers. So remember the learning outcome here, discouraged workers are not part of labor force because they are not actively looking for a job. They just say they are available for a job, but they're not actively looking for them. So they won't find it. So you cannot really say that as a measure of unemployment rate. It's bad to do that. So you don't put them into labor force, because most of these people, do you think they will be employed or unemployed? Because they are not making an effort to find a job. They're not actively looking for a job, although they say, okay, we are available. Right, so now, okay, moving on to a new topic. Unemployment is done, so we're moving on to a new topic. Inflation is getting more interesting now. What is inflation, guys? What is inflation? How do you say inflation? How do you measure inflation? What is inflation? Anybody want to talk about it? We still got 10 minutes so we can discuss some of the interesting stuff on inflation. Can you guys tell me what is inflation? Increase in prices. There you go. Prices go up. So we're going to talk about inflation, disinflation, deflation, hyperinflation, so many things. Okay, inflation, persistent increase in the prices. Prices continue to go up is inflation. Inflation rate is the change in your inflation index. You use different indices to calculate inflation. The change in the index from one period to another is the rate of inflation. Change in price level from one period to another is the rate of inflation. Disinflation, you should understand this. Always this is confused with deflation, and this is a very often tested exam question. So please pay attention to disinflation and deflation. Disinflation is basically your inflation falling down. It doesn't mean that you have deflation. For example, you say your inflation is basically your inflation is, let's say, 10% last year. This year it's 8% and becoming 7%. This is disinflation. Right now, what is deflation means? Your inflation is negative, -5%, -6%. This is deflation, meaning the price levels drop. But what is disinflation? Your prices still increase, but they increase at a slower rate than what you saw historically. So this is very often tested. So you should understand how to look at it. Right, so now we are going back to the slide back again. Disinflation. decrease in positive inflation over time. But do you still have positive inflation? Yes or no? Can you think about it? Do you still have positive inflation with disinflation? With disinflation, do you still have positive inflation? Yes. What is deflation? Deflation means your prices continue to drop persistently. That is deflation. Okay. What is hyperinflation? Hyperinflation is like, uncontrolled amount of inflation. The inflations, are out of control. Like what countries like Zimbabwe is experiencing the inflation is like kind of out of control. It's just like 50%, 100%, things like that. That's what you say hyperinflation. Make sure you understand these terms: inflation, disinflation, deflation, hyperinflation. They are potentially be very good candidates for MCQ questions. So now we're going to talk about how do you measure inflation. There are inflation indices that are going to be used to measure your inflation from one period to another. So that's what we mean inflation indices. So what is this index? This index is going to have a basket of goods and services. So you're going to say, okay, let's say you got food, beverages, and then you've got clothing, shelter, oil, transportation. There are different areas people spend their money, isn't it? So each of them are weighted according to how much money people spend on these various type of expenditure based on national expenditure surveys. Based on that, you arrive at a weightage for each expense category, and then you're going to see increase or decrease in those prices of those uh, items in your index compared to a base period that's going to be used to calculate your inflation rate. So you're going to calculate inflation based on price indices, where you're going to have various weighting schemes for different products and services that you have, and you're going to compare the current prices with the base year price to understand what is the rate of inflation. So consumer price index is the most popular one, which measures the cost of fixed basket of goods and services compared to the cost of their base period. So what you do is you look at the cost of the basket at current prices divided by the cost of the basket at the prior base year prices times 100. This is why your consumer price index is calculated. So there's an example question which I'm going to discuss with you. Easy to understand. See what's happening. We're going to calculate the consumer price index. The following table shows the price information for a basket of goods: cheeseburgers, movie tickets, gasoline, digital watches. These are the quantities, which is the weighting. Remember, I was talking to you about weighting. So your weighting doesn't change. You consume 200 units of cheeseburgers, 50 units of movie tickets, 300 units of gasoline, and 100 units of digital watches. That's what you do. And this is a price: $2.50, $7, $1.50, $12. So this is the current price. This is the base price. This is your base quantity. So what you're going to do first, you're going to multiply this quantity by the base price, get a number, and then you're going to multiply quantity by the current price, get a number. You're going to compare them, and you're going to divide one by the other, and that's going to give you your CPI. Easy, isn't it? Look at what's happening: 200 times 2.5, base year prices, current prices, add them up. So what happens? New prices is 2,900, which is the prices at current prices at base year weighting. Weighting is the same weighting times your current prices, 2,900, and the weighting times the base period prices is 2,500. So the prices have increased from 2,500 to 2,900, weighted based on these fixed numbers. So index times 100 gives you 116. And so it's 16% is your inflation. 116 divided by 100 minus 1 gives you 16% is your inflation. Is this clear, guys? Can you understand how to calculate inflation here? Make sense? Does it make sense to you? Is there any confusion? It's easy, isn't it? Not difficult at all. What you do, you take the base year units, multiply by the base year prices, get a price value. Current period, you use the same weighting, same units, multiply by the current prices. So then the current value, current prices times base year units divided by base year prices times the fixed units gives you CPI. And then you calculate inflation based on the CPI index. Right, so now, so basically, I'm going to finish up today. So it's going to be 4:28 p.m. So we are going to meet at the same time tomorrow. We are going to go, into more details. We get almost 120 slides today. So basically, what's going to happen is that we're going to finish up economics on Wednesday. So we're going to have 2 more classes on economics, which is tomorrow, and on Wednesday will be the last class on economics. So if you guys, then I'm going to thanks for attending today. Happy Iftar. I'm going to see you tomorrow at 1:30 p.m. Doha time. Thank you and have a good evening.